Hello, I'm Ryan Lightfoot Amanoff of Chelsea Financial Services. And today I'm joined by Roberta Barr, who is a fund manager and head of Value Team ESG at Schroders. Roberta, thank you very much for your time today.
My pleasure.
And when we think about ESG stocks, we typically think about those companies who are making technological advances, help climate change, growth kind of companies, and certainly not in typical value areas like oil and gas or financials. So how do you fit ESG inside value investing?
Yeah, that's certainly true. And to be honest, some of the innovation to help climate change going on in those growthy companies is, absolutely amazing. But I guess there are 2 points that I'd make. So firstly, the sort of typical oil and gas or tobacco companies that you might think of when you think about value investing, they're not the only sectors which are currently screened as significantly undervalued at the moment. So actually in our sustainable value funds, where we only hold sustainable leaders, so those are basically companies which have got a net positive impact on society, so doing more good than harm, and are industry leading, and are leading their peer group for what they're doing in terms of sustainability. Well, actually, the opportunity set for those sort of companies who are also in the cheapest, say 20% of the market, which is where we normally look for value companies, well, actually, the opportunity set there is abundant. And there's certainly enough choice for us when we're looking for value companies which are also sustainable. And then secondly, I think I'd say that sustainability isn't all about those growthy renewable energy companies. That they might be sort of fashionable and exciting at the moment, but actually, in order to properly move to a sustainable world, sustainability is going to have to be more of a systemic change. So if you just think about our everyday lives, you go to the supermarket to pick up some groceries. Well, actually, how is that supermarket tackling, say, food waste or packaging waste of plastics? How is that company addressing nutrition and health? So is it coming up with reformulation initiatives to help make the population eat a healthier diet? And how is it treating suppliers? So is it paying farmers fairly? And is it, has it got appropriate payment terms? And then I guess the other area to address is probably financials, because that's obviously a very undervalued part of the market at the moment. And quite often banks are really demonized for the financial instability that we saw in the financial crisis, or also for the financing of fossil fuel companies. But actually, these banks have totally transformed over the past decades. They've been forced to deleverage. They have much bigger buffers. And actually, today, these are the companies which are propping up society, say, as we just saw in the pandemic, when they were actually providing financial stability to the population. So we can definitely find sustainable leading companies, which are also banks, which offer the stability, which have tight consumer finance protection, and probably provide access to finance for the underserved. And if they do have any exposure to fossil fuel financing, they're gradually reducing this in a sensible and pragmatic way. And also, don't forget that on the other side of these coins, these banks are often the ones who are providing financing to climate solutions. So they're often the ones giving capital to these more growthy tech renewable companies. So yeah, I guess I'd just say that sustainable leaders, they're much more than just those renewable energy companies. To us, they're more about companies which are acting in a good, responsible way and promoting best practices in their industry. So aligning to scientific-based carbon reduction targets, fighting forced labor, improving the health and well-being of society, providing medicines at affordable costs to the population. Those are the sorts of companies that we're looking for, and trust me, there are more or enough of those in the cheapest part of the market.
Thank you. That sort of neatly leads me on to my next question. Actually, is that one of the arguments for value investing is that it's the engagement angle. It's better to invest and improve in a company using your shareholding than it is just simply ignore them. So do you find that you have to engage more with your value stocks than some of the growth stocks when it comes to ESG? And are you essentially doing some of the hard work now for growth investors in the future?
Well, I mean, I'm a pure value investor, so I can't really comment necessarily on the comparison of how much hard work each of us have to do. But perhaps I would say that, if we hold a company today that's undervalued, we engage with them and we see meaningful progress, and say the company recovers, the market re-rates it, and they've got that sustainable progress from our engagements. Well, actually, that's a raging success for us. we've made great financial returns, and we've helped to improve society through our engagements. But actually, I think the point that you're getting at is a really valid one. So we're often challenged that companies which are ESG industry leaders are already valued at a premium, so not necessarily attractive value stocks. And I guess the thing I'd say here is that we've done a huge amount of quantitative analysis into whether or not that's the case. So we've analysed, say, MSCI ESG scores, which are all industry relative, and actually we found the proportion of companies in the cheapest part of the market who have got the highest ESG ratings, so A, AA or AAA in MSCI, actually the proportion of companies which have that industry leading aspect is exactly the same as you see in the most expensive part of the market. And we have a very similar situation when we look at some of the proprietary Schroders sustainability tools. So in our analysis of those, we definitely conclude that there's no obvious bias for industry leaders being valued at a premium. And then secondly, I probably would also point out that the sort of companies we're buying in our sustainable funds are underloved and undervalued, not because of their ESG credentials. They're all ESG leading already, so they already have that positive impact on society and industry leading. They've just perhaps fallen out of favor in the markets for other reasons. So, you know, something like a pharmaceutical company where there have been concerns historically over the patent cliff that they're facing, or, you know, companies which are going through a significant business transformation, which has meant, you know, a few years of pain for the shareholders. So we're not expecting these companies that outperform the market thanks to our ESG engagements, leading a change to the company's ESG profile. To be honest, we think the ESG profile is already good and we're just going to be improving that further. We're expecting to outperform the market in our funds because of value working, because we think that the market is currently overreacting and irrationally pricing these companies. And where we expect to see the premium is when they're re-rated or the company begins to recover.
And we've talked a couple of sectors already, but you seem to be finding quite a few ESG opportunities in the telecom space. Why exactly are you finding companies here? What's going on with that?
Yes, I mean, it's such an interesting point because, in my opinion, telecoms are a massively underrated, sustainable company. So actually, I think there's already quite a lot of academic evidence out there that sort of highlights the positive impact on society that access to communication has. So I guess, like, where would we be today if we didn't have you know, stable communication networks, access to internet, to broadbands, the access to work from home during a pandemic? Actually, the direct impact that these companies have on innovation, education, productivity is huge. I think actually there's one study from the World Bank which showed that for a 10% rise in broadband penetration in a country, you can expect to see a sort of 1 to 1.5% increase in GDP per capita. So a huge impact. So I guess when we're looking at telecoms to find those sustainable leaders, we're looking for those which have got those good access to communication programs, good data protection and privacy, because obviously that's quite a big area of concern for, say, a telecoms company, and good corporate governance. And we're certainly finding some attractive opportunities there.
And then going down one level further, you've talked in the past about IBM being an example of a stock you hold in some of the funds. People will think of this as sort of a very old school tech dinosaur. What makes it a good ESG value play?
Yeah, well, I'd say is precisely that, people thinking of it as a tech dinosaur, which probably means that it's so undervalued, we believe, today. And from the ESG side of things, well, there's a lot to like actually about IBM. So I think that something that's really special for the company is they have really strong privacy and data protections in their own company, but actually they're also a market leader in offering those data security solutions to customers. They have really strong climate change policies in place. So, for example, they're a founding member of the US Climate Leadership Council. But actually, they also have a significant involvement into clean tech innovation, encouraging their customers to also join that net zero journey. And then obviously there's their AI portfolio as well. So IBM's Watson, which I'm sure you've heard about, and all the opportunities that offers to society. So we see some huge ESG benefits in IBM. And then actually, you're right, it does have this sort of huge dying part of the business. But that sort of hides the fact there's also putting a huge amount of investment in growth areas. So cloud, big data, AI, which, yeah, they're yet to offset that legacy business. But actually, they're making a really good free cash flow yield. They're paying a steady dividend. On the valuation side of things, we also see Watson as being a great opportunity. So yes, they've got that huge legacy dying business, but actually those revenues are increasingly being offset by really interesting growth areas. So cloud, big data, AI, and yeah, they're yet to offset those legacy shrinking areas. But actually the sort of valuation you would expect those growth areas to get in the market if they were standalone, the opportunity set there is enormous. And we're rewarded with a good free cash flow yield and a good dividend yield whilst we patiently wait for these to come through.
Well, Roberta, that's been some really interesting insight. Thank you very much for your time today.
Yeah, my pleasure. Thank you, Brian.
And if you'd like to find out more about any of the Schroders funds, please visit our website, chelseafs.co.uk. And for more from our video series, please don't forget to like and subscribe below.